Okay, what's up, everyone, and welcome to the education part of my Coach's Corner stream, Protective Passive Strategies. And today we're going to be going over debit spreads. So, got a slideshow right here that we're going to go over, and it'll probably take about 20-30 minutes to go over everything. But at the end, you should have a really good understanding about debit spreads. Okay, so let's go ahead and jump right in. I wanted to show this slide first, because this shows the different types of vertical spreads. Okay, there's only 4 different kinds. Last week, or I'm sorry, the week before that, basically the last class, we went over credit spreads. Okay, so we got the bear call spread, which is the same thing as a call credit spread. Okay, the bear call spread is that terminology is more, I guess it's been accepted more as a technical name, but there's 2 names for it: bear call spread or call credit spread. I think the more technical definition is a call credit spread, but they're calling it a bear call spread. It's obviously a bearish strategy. That's a credit spread. We went over that in the previous educational class. And then we went over put credit spreads, also known as a bull put spread, which also is a credit. This week, we're going to go over debit spreads, okay, which is a bull call spread. And that it basically is a call debit spread, because we're going over debit spreads. It's all going to be debit spread. So this is actually a call debit spread or a bull call spread. The other type of debit spread is a put debit spread, okay, or a bear put spread. All right, so those are the 2 we're going to talk about today. All right, so a call debit spread or bull call spread, usually you have to be bullish on the stock. Okay, these debit spreads, there is no making money off of theta on these. We need a directional move, okay, because we're paying a debit to open it. And to get a return on that debit, we do need appreciation on the contract. So unlike credit spreads, where a stock could be neutral and trade sideways, and theta decay helps us out, and that's how we get to realize our credit, and it can work that way. Debit spreads, it don't work like that. You need a directional move, because you're paying a debit, and to get a return on that debit, you need to see appreciation on your debit spread. Okay, so that's bull call spread. We do that when we're bullish. It's a call debit spread. The other one is a put debit spread or bear put spread. You should be bearish on the stock anytime you whip those out. Okay, so you do have to be directional on the debit spreads. All right, so let's go ahead and dive right into the first one. The bull call spread or call debit spread, same thing. It's made up entirely of call options on the same underlying stock or index, but we use it on stock options, right? Buy call with a lower strike price and sell another call with a higher strike price. Okay, so with the debit spreads, the one you're buying is always going to have the lower strike, or the strike that it's going to be closer to the money is the one you're buying. Unlike credit spreads, where the strike you're selling is closer to the money. With debit spreads, the one you're buying is closer to the money. So easy way to remember how to set the trade up. And it establishes a net debit where you got to pay for it to open it. Unlike a credit spread where we're actually collecting money because we're the seller. So a lower strike call always has a larger premium than a higher strike call. Okay, we know that. Okay, so let's look at an example of a bull call spread. Let's say, for instance, XYZ stock price equals 41 bucks. Okay, so that's the price of the stock. A 30-day to expiration $40 call is worth $3.80. Another 30-day, basically same expiration date, right? $45 call is worth $1. And the reason why it's worth less than the 40, because the 40 is actually in the money, right? If the stock's trading at 41, that $40 call is in the money. The $45 call, well, it hasn't hit yet because the stock's only at 41. So this $45 call is out of the money. Okay, so to establish the debit spread on it, we're going to buy the $40 call, the one closer to the money. That's the one you always buy on a debit spread. It's the one closer to the money. So we buy the $40 call at $3.80. simultaneously sell the $45 call for $1. We get a credit there. That's why it's green. We get it, so we collect that, which offsets the debit we paid on the $40 call by $1. So now the net debit is now only $2.80 or $280 in the option world. Always times 100. So $280 is be the cost to open up that call debit spread or bull call spread. So the example is that the investor who has initiated the 40-45 bull call spread has obtained the right to purchase XYZ at 40, okay, because that's the call that they purchased. But they have assumed the obligation to sell XYZ at 45 if assigned, but having those two going on at the same time, that's what forms the spread, okay? So let's keep scrolling down. So XYZ at expiration, okay? And let me just explain something else out. The max, so that this is what we can do here. So the total value of the spread is $500, right? And you had the $40 call was $380. Simultaneously write the $45 call for $1. And which means you pay $280 to open up the debit. Now, this is what the value of the call spread could be. Okay, so if XYZ price goes up to $47, then you can see here the value of the spread maxes out at $500, right? So in this particular example, and I don't really like the risk reward on this, because you're paying $380 to potentially, in the end, you're paying $280, and then your max profit at the end is only going to be $220. You get your $280 back plus $220, and that's what gives you the $5 value, right? So that's kind of how you would figure out the max profit on it, and you basically just take what you paid $280 for it to potentially make $220, right? So we got to go 220 divided by, I'm sorry, let me reset this. 220 divided by the 280 you paid for it. So this particular debit spread only yields a 78% return. So you kind of see how that works out, the math there. I prefer to, on the debit spreads, I'd like to have, I would, like on an example like this, I would rather pay like $200 for a potential to make 300. So 300 divided by 200, so that this would put us at 150% return on the debit that we paid. Those are the spreads that anytime I use a debit spread, I'm usually aiming for more than 100% return, just as kind of a rule of thumb to let you guys know what the I kind of target. Anytime I trade debit spreads, I'm always looking to get over 100%, no matter what. Okay. So now, and of course, the bull call spread, the call debit spread, you do this on stocks you are bullish on, and that's when you're going to pull out the call debit spread. Okay. So the thing with the call debit spread is the max profit is limited, but also the max loss is limited. So the max profit is the difference in the strike prices, which is a 5-wide spread, so $500, minus out the debit you paid, which was $280. So that would leave us with a potential max profit of $220, right? That's how you figure out the max profit. You take the width of the spread and subtract the credit or the debit that you paid, whatever's left over, that's how much profit you can get on it. Max loss is limited to the debit you paid. It's as simple as that. You paid $280. No matter what, the most you can lose on the trade is $280. That's it. End of the story. Okay, and if you want to figure out your break even on a debit spread, you take the lower strike plus the debit paid, and that's going to give you your break even. So basically, in this example, if you paid $280 for the debit, then you would need the price of XYZ stock to be your lower strike would be 40. Add the debit that you paid for it. So as long as XYZ stock is at 42.80 by expiration, you technically broke even on the trade. Okay. Obviously, on a call debit spread, we would want XYZ stock that was trading at 41 to really go up high. Okay. Now this would be your break even at expiration. Okay. Because it just depends. If the stock was trading at 41 and you entered the call debit spread, then you could technically make profit if it goes from 41 to 42 because it appreciated by $1. You would still make profit. That has nothing to do with your break even. The break even is what the price of the underlying needs to be at expiration. Okay, so just wanted to clarify that. All right, now let's do. This is just an example, but I think the explanation I just went over kind of explained it pretty well. Profit loss diagram. I kind of already went over this. If you paid $280 to enter the trade on a 5-wide spread, your max profit's only $220. The most you can lose is only $280. Okay, pretty self-explanatory. So I want to get to the put debit spread, and then that'll be a wrap for the education part this week. Okay, so what is a bear put spread or put debit spread? It's made up entirely of put options on the same stock. You buy a put with a higher strike price and sell another put with a lower strike price. So of course we're on the put side. The higher strike is going to be closer to the money, right? And the one you're selling is going to be further out the money. And it establishes as a net debit. So a higher strike put will always have a larger premium than a lower strike put. Because the higher strike put is going to be closer to the money. That's why the premium is more. Okay. Let's go to the example here for bear put spread or put debit spread. Okay. ABC stock trading at 51 bucks. Okay. Let's just say we're our bias is bearish. We think it's gonna sell off. It's trading at 51 bucks. We go to the option chain 30 days out for this example. And there's a $50 put selling for $2.30. And then there's a $45 put selling for 7.70 or 70 bucks. Okay, so when we open up this spread, we're going to buy the $50 put, which is closer to the money because the stock's trading at 51. So we're going to buy the $50 put, okay, for $2.30 or 230 bucks. Simultaneously sell the $45 put, which is further out of the money. That's why it's cheaper, for 70 bucks. That's when we write that, we're selling it. So that's going to be a credit. Subtract that from the 230, gives us a net debit of $160. See, I love this example because look at the risk reward on this example. We already know 5-wide that this thing's worth 500 bucks. Okay. If we only paid $160 to open it, that leaves a $340 profit on the other side of the trade. That is a beautiful risk reward. Because if I have a chance to make $340 on only a $160 investment, boom, that's over a 200% return on my money. 212% to be exact. That's the kind of debit spread that I would be targeting. That other example on the call debit spread, that risk reward, I didn't like that risk reward. Here, I'll scroll back up. Yeah, you're paying $280 to only make $220. That's not even 1-to-1. So that this is a good education purposes on what risk reward is acceptable, at least for me. This bull call spread or call debit spread, that risk reward's not there for me. I'm risking $280 to only make $220 on a debit spread. Now I'll do this on credit spreads because we have more opportunities for credit spreads to work out because theta is working in our favor. The stock can actually trade sideways as long as it's on the right side of our spread. We're good. So my risk reward on credit spreads, I'm obviously willing to take less than 1-to-1 on those because we have more of a chance of the credit spreads working out. But for debit spreads, I wouldn't do anything less than 1-to-1 risk reward. And on this bull call spread, we're not getting that. So I wouldn't do that trade. But this trade on the put debit spread, and scroll back down, we're only risking $160 to make 340. This is the trade that I would do. Okay. All right. So let's go down here. Kind of already talked about the chart. The max profit is the difference in the strike price minus the debit we paid. So very similar to the call debit spread, the same kind of metrics. Okay. And max loss is limited to the debit that you paid, and we only $160 risk on this to make 340. That's a pretty good risk reward, and that's what your max loss would be the 160. And then the break even is just the higher strike minus the debit you paid. Okay. And this was the example. Profit and loss, we already went over this. So max profit of 340, max loss of 160. Okay. And went over that. This is credit spread. So that basically wraps up the educational part for the debit spreads. Again, a call debit spread, you're bullish. A put debit spread, you're bearish. And pretty good explanation on those two types of debit spreads. Doesn't look like we have any questions. And yeah, that was almost like 20-minute educational class. So hope everyone enjoyed. And I'm going to go ahead and end the video because I know we've been here for, if you add up my other stream, that's going on an hour and a half here.